Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Australians are becoming smarter with their use of credit cards, but banks are increasing fees as a way to recoup lost revenue. Financial comparison site Mozo has done a detailed analysis of credit card rates, fees and spending across the last decade. It's a period that also captures the rise of buy now, pay later, which has been thoroughly embraced by Australians, highlighting the need for better tracking and regulation. Rachel Wastell is the personal finance expert at financial comparison site Mozo. Rachel, welcome to Fear and Greed.
Thank you so much for having me. Pleasure to be here. I love talking about credit cards.
A decade is a long time, especially in credit cards. What's the standout trend you've observed?
Yeah, so a positive thing that we have seen over the past decade in terms of the credit card market is that Australians are becoming savvier with spending. Their transactions are getting smaller and the balance accruing interest, so the balance they're not paying off by the end of the billing cycle, is reducing. So we've seen a dramatic drop. There was a 45% drop in the balances accruing interest according to the RBA in the past 10 years, which is massive. And the average spend has dropped from $118 down to $90.
Okay, so people don't have those as well. They still have big debts at the end of the month, but not as big as they did have. What about the actual amount being spent on domestic credit card purchases? Has that gone up or down? What's happened there?
Yeah, so the balance, like the amount that people are actually spending is still increasing, but it's the transaction. So the purchases are getting smaller. So it looks like Australians are actually making smaller and more manageable transactions as the cost of living increases and we're in a higher rate environment. People are kind of looking at their credit card debt a little bit more conservatively. However, there is the risk that it's not just that they're not accruing debt, it might be that they're not accruing debt on their credit cards, because the problem is they've got buy now, pay later services and we can't actually track the amount of debt that is there's no regulatory authority that tracks the level of debt that people have. So there might be a different kind of balance, or the balance as accruing interest is dropping and it's just been repositioned into the BNPL debt market.
That would be worrying, wouldn't it, if more people have buy now, pay later, because that particular method of payment seems to be going from strength to strength.
Yeah, I think what's most concerning is we did some research recently and we found that 54% of credit card holders also had at least one BNPL account. So that means that it might be positive that we're spending less on the credit card, but we're just kind of off-putting these payments until later. And the problem with buy now, pay later is that people think they have all this money, but you're just delaying the debt. So it's not that you're not accruing the debt, and that is a bit dangerous because you think you have more money than you really do.
Okay, just the 45% reduction in credit card debt accruing interest. Are we more used to interest-free periods? What's the reasoning behind that? Is it the fact that we are having smaller transactions and maybe it's on buy now, pay later? Or is there more to it than that? Are we just getting more savvy?
I think it's probably a combination of both. Unfortunately, we don't have the data to see whether that proportion of debt has just been repositioned. So we can't really say that. We did some research ourselves at Mozo to look at how much debt people had on average. And we found that across the board with BNPL users, they had about $919 of outstanding debt. And some with 4 BNPL accounts actually had $1,700, just upwards of $1,700 on average in debt. So it might be that they're just kind of transferring that outstanding debt, which is smarter because you're not paying, that double-digit interest on a credit card, but it does just mean that's repositioned rather than actually getting rid of that debt. So I think there's a few factors at play. Also, people are becoming savvier with spending as things get more expensive. And I think we're getting used to this idea of having that, part pay and kind of pushing your payments back and not really wanting to commit to paying double-digit interest.
Stay with me, Rachel. We'll be back in a minute. My guest this morning is Rachel Wastell from Mozo. Okay, so back to credit cards. One of the things you found, which I thought was really interesting, is that there were more low rate and more high rate cards, where the decline is in the mid-range cards. Why? And is it a good or a bad thing for consumers?
So this was the most interesting thing we saw. It was like a polarisation of the credit card market, and those mid-range cards between 10 and 15% per annum dropped by 57%. So that's quite a lot. It lost about 44 cards over 10 years in that space. But we did see a very big growth in the low rate. So cards under 10%, they grew by 600%. There was an extra 12 cards added to that pool. But we also saw, that the 25% and over, and definitely that 20% and over growing as well. So I think the polarization is for two reasons. The higher rates are likely banks trying to recoup the interest revenue that they're losing because people are transferring or kind of changing their patterns to rely on interest-free debt rather than credit card debt.
Mm-hmm.
And balances are accruing interest are reducing, so there's less kind of interest earned there. And then on the lower side, I think there's an opportunity for smaller brands and smaller providers to come in quite competitively and attract the credit card market away from the bigger banks that are charging a little bit more.
Okay, and that's the interest rate. What about what's happening on annual fees?
Yeah, so annual fees, especially in the rewards card space, are getting quite hefty. We saw the highest annual fee in 2014 was $700. That in 2024 is the highest is $1,200 per year.
Wow.
So
wow.
Yeah.
Well, how can you get away with that? Just have an amazing reward scheme, supposedly.
Yes. And the things with reward schemes is they can, don't get me wrong, they can be great, but you need to make sure that at least what you're getting back from your rewards is covering the cost of your annual fee. Because if you don't get a positive net return on your rewards and you're not even getting enough rewards to cover the cost of the fee you're paying every year, it's just not worth it. But there are a number of those lower rate cards. They do come with annual fees under $50. So you do have an opportunity to get a low rate and a low annual fee card, but you do kind of have to look outside the big banks and maybe go past that inertia of, sticking with a big bank just for the name.
You do a lot of research into this. What I always find interesting when we talk about this sort of thing is that I would have no idea about any of this stuff on my own credit cards. Is it a worthwhile exercise? I mean, just go to Mozo. That's probably the best option. But is it a worthwhile exercise for individuals to spend time going through all this? Because it seems like a lot of work, and it's actually kind of hard sometimes to sort out whether you're getting a benefit or not from the fee, from the rewards, from the high or low interest rate.
Yes. And on the Mozo database, there's 199 personal credit cards that we reviewed as a part of this analysis.
Wow.
So what consumers could do is Mozo, we just recently released our credit card awards, so Mozo Expert's Choice, where we looked at 199 cards, all the rates and fees, and found the best in terms of the cheapest for certain areas. I think when you're looking for a credit card, first thing, make sure you know what you're paying. So check your rate and check your annual fee, definitely. Check any other fees you've got on there. But the second is you need to make sure that you're not trying to get a card with everything, because there will never be a credit card that gives you the best of everything. You really need to sit back and think, okay, do I clear my balance every month? If not, really opt for the low rate first. If you're good at clearing a balance, try and find a low annual fee with a low rate as good as you can to get that. And if if you have a huge pile of outstanding debt on your credit card, you might want to opt for a balance transfer to reduce the interest on that. If you're great with spending and you want to do great with your credit card and money management and you want to get some good rewards and you go on a fair few holidays a year, then you might actually get the best bang for your buck by spending a high annual fee and then getting all the lounge passes and concierge service and discounts and It really depends on what you're looking for. But the first thing is look at your statement and figure out what your rate is and what your fees are.
Just moving beyond credit cards, we started talking about buy now, pay later and the fact that we don't know a lot about it. What sort of changes do you think we need in that space, be that regulatory or even just tracking or something like that, to try and get a handle on how much debt there is in that buy now, pay later space? Because ultimately people have to pay it off. So what kind of are we missing at the moment?
Absolutely. I think the key would be first to start tracking it. I know that new regulation was introduced earlier this year to make sure that consumers were protected, but we're still not seeing what the level of debt in that area is. And that, I think, is the most dangerous and I guess, most crucial point, because it does look like from the data we had and the analysis we did that there's this positive shift and consumers are being more responsible and we're reducing our balances accruing interest and we're spending less per transaction on credit card, which is great. But if there's this hidden pile of debt that we're relying on, and now you can use buy now, pay later for fuel, you can use it for everyday essentials. So are we kind of relying on a service that we're not even properly tracking? I'd love to see it in the way I see the RBA retail payments data, to be able to look at it and how it's changing and how it's kind of growing in comparison to credit cards. But right now, we don't have that data available.
And finally, Rachel, we've been talking about what's happened the next 10 years. Anything that we should really keep in? I mean, people will still be using credit cards. Buy now, pay later is here to stay, I presume. Anything else that we should be keeping an eye on?
I think it'll be interesting to see how the younger generation, specifically Gen Z, whether they do end up kind of in that credit card cycle. I think it is buy now, pay later may kind of grow to be a bigger beast than it is now. I do think that, don't I guess, take this as gospel, but there is a little bit of a fear in me that just like Netflix and Prime Video, they came in as these subscription services and they were completely free of ads and they built up their subscription model and now they're introducing ads. Yeah. So I just think there's perhaps, in the future, if we do become very reliant on these buy now, pay later, and it's very consolidated market, very concentrated market with only a few major players. If they do get a handle on the credit card market and we're not tracking it, it will be interesting to see what types of fees and charges are introduced once they grow their market share.
Interesting. Rachel, thank you for talking to Fear and Greed.
Thank you so much for having me.
That was Rachel Wastell, personal finance expert at financial comparison site Mozo. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.